Don't play with it, don't be dishonest. Ay, still not under.
All right, today we're going to pull back the curtain on a trading concept that can, and I'm not kidding, completely change how you see the market. We are going to break down step by step how you can find those high probability supply and demand zones. You know, the kind of setups that can give you a serious edge. You've seen it 1,000 times, right? You're watching a price just climb, and then, bam, it hits some kind of invisible wall and just plummets. Or it's in a total free fall, and then suddenly bounces like it hit a trampoline. It's one of the most frustrating things in trading, and it's a question we've all asked. Well, the answer, almost every single time, comes down to this. A massive hidden imbalance between buyers and sellers. These big, explosive moves, they are not random. Not at all. They happen at very specific spots where one side of the market just completely overwhelms the other. And that is our entire mission for this explainer. By the time we're done here, you're going to have a simple but really powerful framework for finding these exact spots on literally any chart you look at. Okay, let's get right into it. The entire strategy, and I mean the whole thing, hinges on one critical signal. It is the very first thing you have to look for, and if you miss this, honestly, the rest of the pattern is pretty much useless. This right here is the absolute foundation of this technique. So forget everything else for just a second. The first thing you must find is a powerful, explosive price move away from a level. That right there is your big sign that a huge supply or demand imbalance just took place. Okay, now look at the difference here, because this is so important. On the left, that's what a lot of traders get wrong. It's all choppy, it's messy, it's really not going anywhere. But on the right, oh yeah, that's the money shot. See those big, powerful candles just blasting off from that base? That is the signature we're hunting for. That's a high probability setup. So, you found that explosive move. Awesome. The next question is, what actually created it? Well, it almost always boils down to one of two core patterns. First up, we've got the drop base rally. It's just like it sounds. You see the price drop, then it goes sideways for a bit in that base area, and then boom, it just explodes upward. That little sideways area, that's our demand zone. And the second pattern is the rally base rally. This one's a continuation pattern. The price is already moving up, it takes a little breather to consolidate, and then it just continues its climb. This is telling us that the buyers are still very, very much in charge. And of course, it probably goes without saying, but for supply zones where we expect prices to fall, the logic is simply flipped upside down. You'd be looking for a rally base drop or a drop base drop. Everything we're talking about for demand applies perfectly, just in reverse, for supply. So, you've spotted the big move, and you've identified the pattern. Now for the million-dollar question, right? Where exactly do you draw the lines on your chart? The basing area is actually super simple. It's just those small sideways candles that form right before the big explosive move. They might look like doji candles, you know, the ones with small bodies that show indecision, or maybe what we call 50% candles, where the body is about half the total range. It could be one candle, maybe two or three. The key is, this little area is the origin of the imbalance, and that is where you draw your zone. Okay, now for the pro tip. This is an advanced technique that can take this whole strategy from being good to being absolutely great. If you've ever heard people talk about sniper entries, well, this is how you get them. And it can dramatically improve your risk-to-reward ratio. It's a really simple 3-step process using multiple time frames. So first, you find a valid zone on a higher time frame. Let's say the 4-hour chart. Then, step 2, you drill down. You zoom into a lower time frame, like the 1 hour. And finally, step 3, you look for a smaller, more precise zone that exists within that larger one. Let's make this real. Take a look at this example with Meta stock. On the 4-hour chart, finding the demand zone would have given you a solid 4-to-1 reward to risk trade. I mean, that's a fantastic setup all by itself. But watch what happens when we apply that sniper technique. By drilling down to the 1-hour chart, a trader could have found a much tighter, more refined entry inside that exact same zone. And that one simple step. It turned the same trade into an absolutely incredible 8-to-1 reward. I mean, that's the power of this right there. Just by going from a higher to a lower time frame, you can potentially double your reward on the exact same trade. And you're not even taking on any additional risk. It's a game changer. So let's put it all together. Quick recap. Number 1, Always hunt for that big, explosive move first. Number 2, identify the pattern, like a drop-based rally. 3, draw your zone around those little basing candles. And finally, if you want a massive boost to your potential reward, refine that entry on a lower time frame.
So there you have it. You now have the exact blueprint for spotting some of the most powerful turning points in any market. The only question left is, where are you going to find your next great trade?